Really, all we need to say about this is that these disclosures do apply to the presentation in its entirety. And if you do want a copy of the presentation, feel free to reach out to your representative at Borden Hamman, and they can get you a copy of this presentation as well. So we'll move on from that. And what our goal today with this call is to give you in the field a different idea, something additional that you can use life insurance for that maybe isn't standard to what we're typically doing in the field. So we're going to go through our smart money concept. First thing we're going to do is define smart money. What is it? What should you be looking for when you're talking with your clients? And I think the conversation happens a lot where there's some sideline money that a client has that it's just the untouchable type of a situation. I save that for an emergency. If the emergency doesn't happen, it's going to the kids. I think this is an area where we can, offer you an option to show those clients. So we're going to look at life insurance and how that can be a solution for that client. And then we'll go through some tips and talking points, really just on how to set up the illustrations, what you want to do, and where you want to focus when we're talking about these types of sales. So when we talk about smart money and trying to define it, it's really accessible assets, money that the client wants to have access to in case of an emergency, and then limited exposure to loss. So we're really dealing with, when we say smart money, you can call it safe money. It's that the money that's not going to go into the market. It's not going to get tied up with surrender charges. We're not going to put it into that long-term annuity. So what I see for when I'm talking with the agents in the field is this is typically money that they didn't have access to. So it was sideline money. So we're not saying take your annuity sale and turn it into a smart money sale. Now that could be the case. That could be one option to do. We're saying get that additional funds, make an additional sale, put additional revenue in your pocket and in your agency's pocket, and we can do that with this solution. So a little more on smart money, define what types of assets are we really looking towards for the smart money. We're looking at annuities, money market accounts, savings accounts, even a recent windfall or inheritance. So typical funds that we would see with the smart money concept are really everything on this page. It's not limited to this by any stretch. You could present this to a client and they could really want to move with some different types of funds. But when we're looking at smart money and that typical sale that is kind of on the sideline, these are the kinds of assets that we're looking at. So what is when we're looking at smart money, again, what are the client objectives? What is the the primary objective of the client? We kind of talked about this before. Is this is typically money that they want to have access to in case of an emergency, but the end goal is that it's earmarked to leave the beneficiaries. So with this, we can actually offer them a solution that is going to be better than where they currently have it sitting, because we can we have the access to the death benefit. That's going to be huge, and a lot of times when you're dealing with clients that have kids that are expecting to get this inheritance, they know that money is earmarked for them at some point in the future. When the parents start moving things around, they want to be involved in that sale. So when you're talking with your clients and you can show them a way to potentially earn a better interest rate on the funds that they have, which is going to be their benefit, and still have access to the funds, which again is their benefit in case of an emergency, why not show them something that the kids are going to say yes to as well? So we're looking at the death benefit. When we can leverage the funds that we have here into a higher death benefit for the beneficiaries, I think you're going to get yeses across the board as far as making those moves. So we want to make sure to have access to the funds for the emergency, for that unexpected need, maybe future unidentified needs. And where we can really play the future unidentified needs is what happens if mom or dad needs to go into a nursing home or have somebody come into their house and help with care. As many of you know, and some of you may not, we have accelerated benefits on our products. And if you can offer a leverage that instead of the $100,000 that they have in the bank CD, they have $250,000 or $300,000 of death benefit that they can go and access with the acceleration of the death benefit, that's going to be a huge talking point when you're talking with these clients. So that's really the future unidentified needs we're talking about. But we also want to make sure that we're not just offering benefits that are going to be good for everybody down the road. You could take that money, if you're talking with the kids, and just dump it into a guaranteed UL that has no cash value, create a higher death benefit, and the kids are going to be happy. But we also want to make sure that we have competitive returns so that we can offer some current value to the client and make sure that everybody in this situation gets a win. So how are we going to do this? Obviously, I work at North American Life Insurance Company. We're going to talk about life insurance, with this concept, and I think everybody at Borden Hamman is very familiar with this, and people on the phone may have heard about the concept before. But we want to make sure that we have a product designed that can do all those things that we just talked about for the client, for the beneficiaries, for everybody involved, and obviously create an additional sale for you. So we've designed the Rapid Builder IUL. We've actually just done a revamp on this product to make the cash values more enhanced. We added some additional bonuses. The new product currently is not approved in California. However, we just got word, we have our sales meeting here this week, we just got word that that's going to be happening very soon. So you will have the product available in California in the near future. So what does the Rapid Builder do? It offers that death benefit protection, early cash value access. This is the big thing. This product is designed with a waiver of surrender charge option on it. So it waives all the surrender charges to the client. It gives them access to the full surrender value day one, $1. So if they're putting a lump sum into this policy, they're going to have access to go get it in case of an emergency. Has accelerated death benefits. That's another big thing. In California, it's only going to have the chronic. Most states, it also has critical illness benefit. All states are going to have a terminal illness as well, so in case of those emergencies. And then really long-term performance. That's the name of the game. We have great caps, great guaranteed participation rates, interest rate bonuses that are built into the product. That's the end game here, is to have that long-term performance. So we know that not only is it going to be good for the client today, but we want to make sure that if this does progress into a long-term scenario, they do have some long-term growth as well. So let's jump in and let's take a look at an actual illustration. So what we have here is a fairly typical sale when we're talking about smart money. So this is a $200,000 deposit. It's a 55-year-old male. Death benefit of $508,000. So this is more of a situation where the client is looking for not only the cash value growth, but also the death benefit. One thing I'd really want to highlight is when we look at these values, our account value and our surrender value are the same number. We're not looking at big surrender charges early on. There is that added feature that for you as an agent can sell to a client that this money is accessible. We're not tying this up where you can't get at it. Again, for the beneficiary, where are they going to look where they can get a $200,000, have that money that their parents have, $200,000 leveraged into a $508,000 death benefit day one, $1. Again, we're really trying to make sure that everybody involved in this sale is getting that opportunity for what they need. The parents for the cash value growth, the accelerated benefits. You as an agent, an opportunity to make a sale that might not have been there before, and then for the beneficiaries having that death benefit. And as you can see, that grows very fast. We actually set these up using a cash value accumulation test. For the most part, they're going to be a MAC unless we're dealing with 1035 funds, and we're really just trying to maximize the cash value that we have in this policy. What we do look at is not only the illustration, but built into our illustration software, we have our internal rate of return report. So we can actually go back and show the client, we illustrated 7%, okay? You can do the math. You're not actually taking home 7, but what are you getting? Are we competitive with the other options you have? And as you can see here, we're anywhere from 5 up to almost 6% as far as a rate of return. So I think when we're dealing with the client, they're going to be happy with those types of returns on a safe money investment, especially in today's environment. I think in today's environment, this is a real opportunity that's out there. Money sitting on the sidelines in bank CDs. I don't have the official number. Michael might have it. But there's, we're talking trillions of dollars that are in bank CDs at this point that, for the most part, don't get accessed. So this is, again, a great opportunity for you as an agent to create some additional revenue for your agency.
We're going to jump in here.
Yeah, absolutely.
Another way that we illustrate this, and one of the ways that Reed most likes to pitch this out of our office, is rather than selling it with the money in the indexed account, actually illustrating with all of the money going into the fixed account. Now, North American has had, and we think will probably continue to have, very strong returns in their general accounts. That's certainly influencing that fixed account. Their general account is managed by Guggenheim Partners, and they just about entirely avoided the 08-09 meltdown. I mean, we got a memo from them weeks in advance saying that a meltdown of biblical proportions coming, and they got out of everything risky. It was very interesting, but certainly a good company and good general account. So that fixed account is another option, and we show positive returns even in the fixed account. So if you're not comfortable illustrating a 7% return or something like that, then certainly look at that fixed account option.
Yeah, and oh, go ahead. And even sometimes we as a company illustrate our true-up rate, so our minimum guarantee, which is 3%. So there's another option that you can show the client. That middle column return, as you can see here, we're showing a 3% interest rate. That's our worst case scenario. So if you do have money in the index account, you can fall back on that 3%. And as an agent, it's great to tell your client, here's kind of a range. 7%, you may think that's too high. 3%, you may think that's a little too low. The fixed account's a great option. Or just or you can look at it and say, yeah, it's going to be somewhere in between these two numbers. Nobody has a crystal ball, but both options look very favorable for the client. So I think that's fantastic. So if we can skip ahead 2 slides, now we're going to look at a different way to run it. So before we ran it with a $508,000 death benefit, and for a lot of people that is going to be great, but for a way to actually design it so we can show the far left-hand column, the absolute guaranteed column, our worst case scenario situation, is to really dial back the death benefit early on. And we're going to discuss some of the implications that happen here. It actually does affect some of the new commission options that you would have. But if you're in a really competitive situation, or if the client's not 55 years old, if they're 70 years old, dialing back the death benefit to a more minimum amount can actually really enhance what happens in the guaranteed column. So you can see here with this client, we look out 10 years, and it's probably going to go out to year 20. In this scenario, we have even on the worst case scenario, so our highest expenses, highest insurance charges, we have that $200,000 after 10 years growing to $212,000. So at that point, if the client wants to walk away, if we have actually done that, which isn't likely, which has never happened, but if it does, this client walks away with a positive return that's probably going to be better than where they were at before. So this is another way to design it. And again, it's going to depend client to client, scenario to scenario, but there is some flexibility within how we design these policies. There's not just one way that we have to do it. Like Michael said, putting all the money in the fixed account, if you can sell it based on that, and then even if they decide to put a portion of it in there, if you can make the sale in the fixed account, they're going to be really happy, with what the indexes look like when they actually have the policy. So now we can get past this, and we're going to look at kind of just check off the list. What do we do? We had the money for the beneficiaries. Check that off the list. We had access to the funds with our waiver of surrender charge option, and then we had competitive returns. So we're good there. The third portion of the presentation here today is going to be tips and talking points. Some things that may come up with a client like we're looking on this page here, mech status. Typically with these sales, the policies are going to be mechs. We're not as worried about that because the taxes are still deferred. The client still has the option of when they're going to pay tax on this money. If they end up leaving it all to the beneficiaries, death benefit is generally going to be tax-free, as long as their estate's in order. If they do decide to pull the money out, they're not going to pay any taxes until they actually make that withdrawal. So again, the client is in control of when they're paying the taxes on these plans, which is a great thing. We do have systematic premium allocations. So a lot of times clients putting in a lump sum. If you want to do a little dollar cost averaging, we do have an option where they can split that premium up over a 12-month period. So we'll kind of bleed that premium into the policy, based on the client's request. So that's something to think about. Cash value accumulation test. We're using that so that we can, really dial back that death benefit. It's not required. You can certainly run a guideline premium test that's going to just make the death benefit be a little higher initially, and you might not get as strong of cash value growth early on. And then the big one, the waiver of surrender charge option. This is, really what completes this sale, where you can tell the client that if they do want to go in and pull their money out, they have access to those funds without any surrender charges. So that's a real positive. With the waiver of surrender charge option.
Another comment on using the cash value accumulation test. By utilizing that, there is the potential for clients to add additional premium in the future.
Absolutely.
Whereas with a guideline premium, that's not the case. So we do typically run this using CVAT. It's just going to corridor a little bit differently. Another thing to note is, if we jump back here to the difference between these two, in this illustration here, where you started with an initial face amount of $508,000, you'll notice that the target premium is about $6,900. Well, the target premium is going to be driven by the initial death benefit. And so when we go over here and we show that we've lowered that initial death benefit and really tried to drive that down to where it's now $300,000 in this case, you'll notice that the target premium is about $4,000. So just something to take into consideration in plan design. It's not the only reason, but certainly something to be sure you have eyes wide open.
Absolutely, and we'll see that actually when we go through the new commission options. The final piece of the waiver of surrender charge option that you'll want to know is that, especially if you're not typically selling life insurance, if you're an annuity producer and you like the fact that outside of the financial underwriting that we know is on the annuities these days with suitability, there's not medical underwriting on annuities. The waiver of surrender charge option actually offers a table shave program where we'll shave table 3 up to standard. So it just opens up, broadens the client base that you can look at. You're not necessarily looking for just the most healthy clients you have, which sometimes is the key to life insurance. We're looking really at anybody from a table 3 and down in rate class, and we can get them into that standard rate class. So what Michael was just talking about with the target premiums, we have added additional commission options. Previously on the Rapid Builder, and currently for California, the Rapid Builder, to the commission options, or option A was if you had premium less than $250,000. Option B was if you had premium over $250,000, and that's when you had the waiver of surrender charge option. Now we're offering 4 different commission options. Option A is still there. Option B is still there, which is option A is heaped commission. Option B is heaped with an asset trail. But now we have option C, which is a % of premium. So again, we talked about the annuity salesperson. This is more like an annuity. It's going to be a lump sum up front. And then option D, which we really feel is attractive to all advisors, is an asset-based trail. One thing is that to get these options, we need the face amount to be above the first-year corridor, which is more like that first illustration. So that's going to affect the target premiums and things like that. The second option, if it's below the first-year corridor, so if we're solving for that $300,000 death benefit on a $200,000 deposit, you're going to be, fall back to only have an option A and B based on what the premium is into the policy. So something to think about there. There is.
And I know we've got. I can see we've got actually quite a few RIAs on the call right now, and that option D commission schedule is going to be very, very consistent with your business model. And when you look at the commission payout over, a 5-10 year period, that's absolutely what everyone will choose. It's much more lucrative than an option A or any of the other options. So.
Absolutely, and as you're getting illustrations from the team, there is we have a printout that shows you. Here's the 4 options. Here's what it's going to pay. At that point, it's your choice. So there's, you're not necessarily having to choose it, one option for every case. You can go between the different options on certain scenarios if you have an inkling of what the client's future options are going to be. So yeah, this is a great additional feature that we've added to the product. This, like I said, the C and D options are currently not available in California, but hold tight, they're coming. So we can look at some different. Oh, go ahead.
Why don't you talk about the chargebacks?
Oh yeah, the chargeback. So currently, if you add the waiver of surrender charge option, so if you don't do the waiver of surrender charge option, there's no chargebacks. When we look at being able for the client having the ability to actually pull their entire amount of money out of of the policy, we had to price some commission chargebacks in. So if you do option A, year 1 is 100% chargeback, year 2 is 75% chargeback, year 3 is 25% chargeback. Option B is the same. Option C, the lump sum premium does have some longer chargeback options. So option years 1 and 2 is 100, year 3 is 80, year 4 is 60, and year 5 is 40. What we do have, and then option D is going to be year 1 is 100, year 2 is 50. So that's going to be the least invasive for you as an agent. What we do have is we have 10% free withdrawals built in, and the free withdrawal, when you think about it, is more an agent thing, where the client, they can take up to 10% and you're not going to get charged back. That also is cumulative. So if they don't take 10% year 1, they can get 20% year 2. They don't take 10% years 1 and 2, they can get 30, and so on and so forth. So that is a way that they can get at some of the funds without necessarily getting that having that chargeback fall back on you as an agent. So we want to look at now a non-guaranteed alternate rate. What do we do? What I typically say is it's completely up to the agent. I like running the non-guaranteed alternate at the 3% true-up rate, so our guaranteed rate, so you can show the client what the minimum is. That's really what I look at. Our software automatically defaults to 2% less than what the current rate you illustrate is. So if you illustrate 7, it's automatically going to default to 5. You'd have to go manually adjust it to 3. So just something to think about there. I know that the team at Borden Hamman is doing a lot of the designing, so they certainly know that. We also do have a UL alternative. So if you're not into selling IULs, or the client has a problem with the IUL, we do have our custom growth CV. It's got a lot of the same features, and the next slide is going to actually show an illustration on what the custom growth CV looks like in that same initial scenario that we did. So that same $200,000 going in, this is more of a guaranteed product. It has a current rate. It's got some interest rate bonuses that are built in for being in the policy for a certain number of years. So this does actually illustrate again very well on the guaranteed side. So this could be an alternative if you have issues with selling IUL products. If you need things approved through the broker dealer, this is going to be a fixed rate alternative that you can use. Still sell the concept and just not have the index portion on the policy. That's really all we need to discuss there. Something to think about is that we do have great sales kits, and they're accessible. We have a North American marketing website. just a link. It gets you out to all the sales kits, not only smart money, but all the other sales concepts that we have are on this site. It gives you, some access to some different things, YouTube videos that you can show a client, all compliance approved. Videos for you as an agent, just as a refresher to get more up to speed on the smart money concept, and again, our other sales concepts as well. There'll be client checklists, so fact finders that you can have in here, case studies, brochures, and pretty much everything you could think of on this concept and the other concepts is out on this site. It's just a quick link. You don't have to log in or anything. So that's something that we may want to promote with everybody on the call to have some access to those kits. We also have hard copy kits. If you want a folder with all the information in it, just request that from your marketing rep at Borden Hamman, and we can get those sent out to you as well. So with that, we can wrap things up. Quick summary: we went through what is smart money, defining the smart money and the client that really fits into that category. We looked at how life insurance can be a solution for some of those needs that the client has, with having access to the funds, having limited exposure to losses, those types of things, having the death benefit available for the beneficiaries. So really using life insurance to help with the smart money needs that clients have. And then we looked at some illustrations, how we do our design and what the product options are for that type of sale. So with that, I'll let Michael do his closing.
Yeah, now we get the now you get the good stuff.
Exactly.
Casey and I, we want to go over just a couple of places where this fits with your client, where we see this sold, and things to look out for. So the first I would say is when you have younger clients that maybe they subscribe to the Dave Ramsey financial peace type situation where they've got 6 months of savings or something like that set aside that they're keeping liquid and just in a savings account. Then repositioning a portion of those, don't take all 6 months, but take 3 months and reposition it to a rapid builder product like this, where they're going to have better growth than what they're going to have in a savings account, and they have death benefit because they're probably young and need some insurance. And then they also have the accelerated benefit riders on there. Another place is for business owners. If somebody owns a business, they probably have a reserve account, a couple of months of payroll or something like that they keep liquid, someplace so that they have access to emergency funds. Maybe they have $500,000, $1 million, something like that. Well, take a portion of that. Again, never take all of it, but take a portion of that. Talk to them about repositioning a portion of those into a rapid builder where it can provide key man insurance on the principal or an executive. So you've got some key man insurance. So you have that money working for you in that way. But then also it's accessible if they need it, and it's getting a better return than what they're getting in a savings account, a CD, or in a money market. Now, one other thing I want to be sure everybody is aware of is that if the policy is a MEC, then and the client is under the age of 59 and a half, then they're going to have to pay taxes on the gains, but there's also going to be a 10.5% penalty on that if they're accessing it prior to age 59 and a half. So again, just something to pay attention to. You can do the math on it, and even after paying taxes on the gains, if they were to access the money, and even if they were to have to pay a penalty, it's still a better return than what they're getting at banks and CDs, and it certainly has upside, much better upside potential if they're utilizing the indexed accounts. So that's where we see it used as kind of a life insurance alternative. Casey, can you talk a little bit where you see it used as an annuity alternative?
Absolutely. Thanks. Hi, everybody. I know I've been quiet the whole time, but thanks for passing the mic, Mike. So, yeah, for the annuity objector, we see it come in a lot there. You have folks who maybe annuity is a great fit for them, but they just cannot get past the fact of tying up funds with a surrender charge period, even if it's a product that has a ROP feature to it, return of premium guarantee on an annuity. you're still not getting back, you're only going to guaranteed to get your principal back at any time. You're not guaranteed to get any interest back if you had to cash it out. So this is a really cool concept as an alternative to that, where not only the principal but also the interest that's being earned is liquid day one. And really helps people get out of their own way and make a decision that's better for them than keeping it in a savings account or a money market account, earning 0.02% or something like that. So that's one place we see it used. Another place is for some of these portfolio managers. If you have managed money and you have funds that are in cash within the portfolio, then obviously that's typically not anything that's going to be revenue generating for you or for your client. Client's not earning any interest there. So it may be appropriate, depending on the size of the portfolio, to allocate some of the funds to this as an alternative to that those other cash type accounts. So we see it used there as well. Another note on this is that if you look at the guaranteed columns on these ledgers, and you're watching that cash value grow even less the COI, it's been argued that you're basically getting free life insurance here because the policy's guaranteed minimum interest rate is paying for all the COIs and you're still netting a return. So, if you have a client who's going to be objective to paying life insurance premiums, that might be something that it could be attractive to them as well if they look at it from that angle. One other note that I don't think we mentioned throughout the presentation, I didn't see it yet, was just one thing that comes up every now and then is agents ask about 1035s. And if you do add that waiver of surrender charge rider, then it is going to eliminate the ability to 1035 funds until 15 years has passed. 15 years is the standard surrender charge period of the product. So once you get past that point, then you got 1035 on the table again. But prior to that, you do not. So it's going to be taxed just like any annuity would. If you cash it out early, you're going to pay taxes on the gains. Obviously, cost basis would be the premium paid. So anyway, it's a couple notes there that might be good to know. Also, we ran everything at standard in this presentation. There's actually a couple other levels above that. So if you have someone who's very, very healthy, there's preferred, there's also super preferred, and those guaranteed returns look even better the more healthy the person is. But that 3-table shave is excellent for standard rate class as well. So those are my notes. If you have anything else to add.
Yep. Don had asked what are the available, what are the current crediting methods available and the associated caps. Don, I'm going to jump back here to one of the illustrations. So this shows the crediting methods that are available currently, and the annual point-to-point. What are you all at right now, Andy? Is it 13.5?
12.5.
It's 12.5
on the 12.5% on the annual point-to-point. There is a ton of other options. We can certainly, send out the options, but all the options, all 13 options, are going to be available on the Rapid Builder 3.
Very good. And Don, if you want more info on that, just pop me an email or a phone call, and I'll get you anything else on that. Anybody else have a question? So raise your hand on the GoToMeeting.
Well, we're waiting on more questions. Just want to let everybody know. Of course, if you need an illustration, reach out to us, call us, or email us. We'd be happy to run those for you in any number of scenarios that you want to see. Or if you're more hands-on and you want to learn how to run them yourself, we'd be happy to do a training session with you and introduce you to the software so you can learn how to do that on the fly if you need to during client presentations.
All right. Well, again, thank you all for registering and for joining us today. Hopefully this was useful information for you. If you need quotes, please give us a call. We do have a general marketing email box, marketing@Borden Hamman. If ever you're looking for something and don't have a specific person here in our office that you care about, who's going to run it, we all monitor that box all day. So first available, just grab it and send you what you need. Any of the marketing staff in the office, whether it's John or Brooks or Philip or Reed or Casey or I mean really anybody can run, or Connie, anybody can run this concept of these products and talk you through it. So again, thank you very much. We'll send you out the recording and a copy of the PowerPoint, and we hope you have a really nice day. Thank you.